Hello and welcome back to another Dividend Bear video. Today's topic will talk about why you should start dividend investing as soon as possible. Every investor hopes to make huge financial gains and generate more money in the stock market. The primary aim of any investor in this volatile market is to profit from the growth in share value appreciation. However, there are other ways to make money and profit from the stock market than that. Investing in dividend-paying companies is a good and straightforward way to ensure a consistent and steady stream of income. This video may help a prospective potential investors understand what dividend stocks are, the essential elements that make up dividend stocks, and why they should consider investing in dividend stocks. We should start with a broad overview of dividends. Dividends are payments paid by a company to its investors or stockholders in order to share profits. When a corporation produces a significant profit and accumulates retained earnings, those gains may be reinvested in the company or given to shareholders as a dividend. The dividend yield is calculated by dividing the yearly dividend per share by the share price. They are paid on a regular basis and are one of the various ways that stock investors earn from their investments. A dividend is calculated per share and dispersed equally to all owners of the same class of stock, such as common, preferred, and so on. The payment must be authorized by the board of directors. When a dividend is declared, it is paid out on a certain day known as the payable date. Here is a brief timeline of how dividends return to investors. The following are the general stages involved in dividend payments. First, profits and retained earnings are generated by the firm. The management team then agrees that part of the extra earnings should be distributed to shareholders rather than reinvested. The board then approves the intended dividend, and the company announces it, including the amount per share, the day it will be paid, the record date, and so on. Finally, the dividend is distributed to stockholders. A company can pay many forms of dividends to its shareholders. We are going to discuss some of the most prevalent and significant categories to be aware of. Cash dividends are the most prevalent sort of payment. This is the payment of actual cash from the company to the shareholders. Payment is normally made electronically, commonly through wire transfer, although it can also be made in cash or by check. Stock dividends are given to shareholders by issuing new shares of stock in the firm. These are paid out in proportion to the amount of shares previously owned by the investor. Dividend reinvestment programs, or DRIPs for short, is a program imposed by companies in which investors are able to reinvest the dividends they received back into the company's stock, and it is not uncommon for it to be discounted. Assets are also one form of dividend return. A company's payouts to its shareholders are not restricted to cash or shares. Other assets, such as investment securities, tangible assets, and real estate, may also be paid out by a firm, though this is not frequent practice. A special dividend is one that is given in addition to a company's standard policy, whether quarterly, yearly, or otherwise. It is frequently the outcome of having too much money on hand for any reason. Dividends are frequently expected as compensation for shareholders' investment in a company. Dividend payments reflect well on a company and aid in the retention of investors' faith. A large dividend declaration might suggest that the company is performing well and making money. However, it may also signal that the company lacks viable projects to create higher returns in the future. As a result, it is using its cash to pay shareholders rather than reinvesting it in growth. A corporation with a lengthy history of dividend payments that declares a dividend decrease or termination may signal to investors that the company is in jeopardy. However, a reduction in dividend amounts or a decision against a dividend payment does not always spell bad news for a company. The company's management may have a plan for investing the money, such as a high-return project that has the potential to magnify returns for shareholders in the long run. So why is investing in dividends a great idea for those looking to invest their money? It is an excellent source of passive income. As we have seen, that corporation routinely delivers high dividend stocks and distributes its earnings to all shareholders. This provides individuals with a consistent stream of income, similar to the interest they would receive if they saved money for a longer period of time. Just as bonds provide guaranteed returns on investments, dividend stocks provide guaranteed returns to ensure that money is invested wisely. They are also much less hazardous than other types of investments. High dividend equities or stocks do not lose value even if the market crashes or a specific event declines. As a result, they are less risky than other growth equities. The nicest thing about dividend stocks is that they regain their value amid volatile market fluctuations, making them a dependable alternative for capital protection for risk investors. When these equities are introduced to a portfolio, they effectively diversify the risk potential. It also helps you reinvest the dividends. When an investor receives dividend payouts, they have the opportunity to use them for personal expenses or reinvest in the same stock. Reinvesting in the same stocks by using dividend payouts can help investors deliver steady returns on their investments with the help of dividend compounding. When investors continuously reinvest their dividend payouts in the stock market, it helps them boost returns effectively. Furthermore, they provide investors with a double benefit. Dividend stocks, while not having a better growth potential than growth companies, do offer the potential for value appreciation. Dealing in dividend stocks allows investors to reap the benefits of both capital appreciation and dependable recurring income. For example, an investor can buy a high dividend stock and reap the rewards for several years. Eventually, he can sell your investment and benefit handsomely from his investment. They assist in the struggle against inflation. While the inflation rate continues to rise on a daily basis, it is critical to make effective and inflation-proof investments. This may be accomplished by investing in dividend equities, particularly high dividend growth firms. They are also less volatile in the market. With dividend stocks, investors do not have to devote their entire time and attention to watching stock fluctuations or other market moves. Dividend stocks are very solid and stable corporations that are less susceptible to market volatility, have less price fluctuations. To begin investing in dividend stocks, all an investor needs is a basic buy and hold strategy. Beginner dividend investors frequently buy equities with the greatest dividend yields. While high-yielding stocks are not always negative, they can result from a stock's price declining owing to the danger of the dividend being slashed or cut. This is known as a dividend yield trap. Some methods one can take to prevent slipping into a yield trap, as many experts suggest, are as follows. Avoid buying stocks simply on their dividend yield. If a company's yield is much greater than its rivals, it's usually an indication of problems, not opportunity. Use payout ratios to determine the long-term viability of a dividend. Put the company's dividend history to your advantage, taking note of both payout growth and yield as a reference. Examine the balance sheet for debt, cash, and other assets and liabilities. Consider the firm and the industry as a whole. Is the corporation's business threatened by competition, low demand, or another disruption? It is preferable to buy a dividend company with a lower but stable yield than to pursue a high but illusory volatile yield. Furthermore, concentrating on dividend growth, including a company's history and potential to increase its stock dividend, is frequently more beneficial. Investment in dividend stocks rewards a variety of people. Whether they are bold or conservative investors, dealing in dividend stocks may provide reasonable long-term gains. Before investing in high dividend companies, it is usually a good idea to do your own research. This will assist them in ensuring that their investment cash is in the appropriate location and provides assured constant returns. With that, I hope that you gain some insight into why you should start investing in dividends. If you've enjoyed this video and learned something, might as well consider subscribing for more amazing content like this one. See you and thank you for watching.